Hi, welcome to T Minus Retirement, the podcast where we help launch your retirement into orbit. I'm Jay Cole.
And I'm Dustin Watts.
So we've been doing the last couple of videos in this format, and we hope you enjoy it more so than the other. We certainly enjoy just it's a little bit more comfortable on our end. We get to sit in our own offices or even homes for that matter, and just seems more effective. So with that, for today's video, we're going to be discussing the potential new tax bill that the House just passed about a week or so ago. And something to keep in mind is nothing's final yet. Obviously, when these bills are passed with one legislature, then it has to go to the other. So right now it's in the Senate, and the Senate's probably going to rip it apart and take things out, maybe add things in, vote on it, and then it's going to go back to the House, and they could do the same thing. So this process can go back and forth for quite some time. But at the end of the day, once both the Senate and the House agree on it, then it goes to the president and they sign it and it goes from there. So, but anyways, we just wanted to talk about the first pass through and some of the things that I know like Trump talked about when he was running last year. I was able to get some of that through and then some other things as well. So anyways, just without further ado here, one of the big things is essentially extending the current tax cuts in the tax rate. So back in 2017, the House and the Senate passed what we currently have with our taxes right now. And so they restructured the tax brackets. They got rid of the personal exemptions. They essentially doubled the standard deductions. So they made it a lot easier for people to file. And essentially, the majority of people saved at least a little bit on their taxes because they were able to get in a little lower of a tax bracket than what was current. So they're going to be extending that, or at least that's what this first bill has. They extended that. The next thing is, and this is kind of big. So with the child tax credit, it's been right now it's $2,000 per child. And that was again something that they had passed back in 2017. It was never indexed for inflation, so it was always going to be that until they either changed the tax law or did something else. So what they're going to do is raise it to 2,500. I know it's not a huge amount, but at least it's a little bit of a raise, and I think it's supposed to stay like that until 2028. And then it's supposed to get indexed with inflation. So after 2028, then it'll go up just whatever the inflation rate is. And so at least, if that does go through, at least then that deduction or credit, I should say, would be going up each year instead of just staying stagnant for 10 plus years. So that's a nice thing, especially for families. They can at least see a little bit more of a tax credit, especially if they have multiple kids. This is one that Trump and essentially Republicans had really campaigned on, and I don't know how they'll make it work, to be honest, but we'll see. But essentially, having no taxes on tips and then on your overtime as well. From what we're kind of reading, it doesn't really go super into depth with that. I don't know if there's going to be an income limit or a certain limit with what the tips are or what the overtime is or how that's even going to be implemented, but that's what they're trying to pass. One that I know I got a lot during tax season mainly from seniors, or actually only from seniors, was the question was, will my Social Security be taxable going forward? And again, that's something Trump had campaigned on. I believe this current bill doesn't have that. And that could be something the Senate adds or they never add. We don't know. But so right now, this first draft of the bill, it's no taxes on tips and then no taxes on overtime as well.
I think what's going to end up happening is people are going to get a lot bigger tips, and their services are going to be kind of discounted as long as you slide them a couple extra bucks.
I know. I was joking about that with someone else, where especially people that are self-employed, they might start giving bills that say what the rate was, and it might be $10, and then they'll do a tip amount for
Yeah.
what the actual amount would be. What, yeah, who knows? I don't know how they're gonna, if that does pass, how they're gonna write that in and how that's gonna be applied. But um, that's big picture. That's what they're talking about.
So real quick, Jay, back to the Social Security, because that is one of the biggest items I think that I talked with clients about, or I'll just say over the last 4 or 5 months, is a lot of people really were hoping for no tax on Social Security. Now, I think the provision is like how they're kind of getting around that, so to speak, isn't there an increased standard deduction for seniors?
Yes. So they're currently talking about, so, let's say you're a married couple and you're a senior. Let's say you're both over 65. I think your standard deduction would be a little over 32,000, 33,000, give or take. Um,
Okay.
they're talking about or this bill talks about adding an additional senior deduction. Um, One I'm not 100% sure on at the moment is if it's going to be per person or if it's just per return.
That's a
Um,
good point.
but they talked about saying that this deduction would be $4,000. So you take your standard deduction and then you just add an additional 4,000 on top of that. The other
Okay.
thing too is I don't know if, like, let's say you itemize. So let's say you don't take the standard deduction. Um,
Right.
I don't know if that's going to be something in addition to your itemizing or not. So let's say you itemize a lot, like you give a lot to charity, you have a big mortgage, um, and you're well above that, let's just say 36,000, 37,000. I don't know if it's an additional amount or not. So they haven't really gone too much in depth yet with that, but that is one way that they're trying to get around the not fulfilling the no tax on Social Security.
Yeah, I think a lot of people are going to be kind of bummed if that's not in, because I know when you talk to people, I think a lot of seniors are surprised that Social Security is taxable when you have other income, as you know. So, if they don't pass the no tax on Social Security, there might be a lot of upset seniors on Social Security. So we'll see.
I know. Well, the other thing too is this past December, January, um, social I forget who it was. I mean, I guess Social Security, but they essentially allowed a back pay for a lot of people
Right,
that were affected by the windfall provision.
right,
And so I spoke with many clients that, you know, all of a sudden got a random deposit from Social Security for 10,000, 15,000, heck, even up north of 25,000. Um, and so they changed that windfall provision, so they're entitled to a little bit more. And of course, if they've been taking Social Security for a long time, then the back pay is going to be much bigger. If there was no taxes on Social Security going forward, then they wouldn't have to worry about that. But if things are still in the air, or if things are going to be the same as how it was, where it is taxable up to 85% of the benefits, well, then their tax bill is going to go up quite. It could be quite dramatically just because of that additional income.
yeah. Well, I've been telling people, the government spends a lot of money, so I wasn't holding my breath on every um, tax decrease, because at some point, the government needs tax revenue to come in to pay some bills. So
Yeah.
ultimately, we'll see what the final bill looks like.
Right, exactly. So we'll see. Again, this is all up in the air. This is just the first round that the House passed, and nothing's set in stone. So we
But
can't guarantee
to
it.
that point, just having the current tax brackets be extended where they're at is a big thing, because if the Tax Cuts and Jobs Act expires and the tax rates go back to what they were previously, that would actually be a pretty big tax increase on most people, I would say.
Hmm.
So at a minimum, we really want those lower tax brackets to be extended, because I mean nobody wants to see their tax rates go up.
Yeah, I don't think a lot of people remember that, like the child tax credit, that was capped out. That was capped out if your income as a married couple was, I want to say, below, or if it was above 200,000.
Yeah, it wasn't
And
super
so
high.
it wasn't super high. And so essentially they capped it out at I believe it's 400,000. They essentially doubled it.
Yeah.
And so a lot more people were able to take advantage of that when they never did in the past. So just things like that you don't realize, hey, this is actually kind of a good thing that happened in 2017.
Well, to that point, another thing that they doubled that they're planning on basically making permanent is the estate tax exemption. And a
Mm,
lot of people, they don't really think of this type of tax, obviously, because a lot of it comes when people pass away, and it's more so people who have some substantial assets. But they had doubled the estate tax exemption from about 7 million to, I'll call it like 15 million is what it's going to be if it passes as is. And, that is a lot of money, but ultimately what that does by them doubling it, it really causes the vast majority of people, they're not going to pay any estate tax, which that's great for all the people who are going to inherit, assets. But also it really cuts down on the need for all these complex trusts and things that
hmm
help you skirt around different estate laws. So I would see that as a good thing. A married couple would have a $30 million estate tax exemption. So I'm sure 99% of people are really not going to be in that boat. So I think that just really simplifies things, and that's ultimately less estate tax that people will have to pay, on assets when they pass away.
exactly, because the tax is levied on all the assets. So if
Right.
everything is it's not, or if the majority of the assets are not liquid, like if it's a bunch of homes, the beneficiaries or whoever's inheriting it's going to have to come up with that tax to pay for it. And if they don't have the liquid assets to do so, they're kind of, they're in a they're stuck.
Well, and it's not just uber wealthy people. I mean, think of people who have ranches and things like that. I mean, those are high value type of land
hmm
and whatnot. So a lot of times those people fall into that category, and the only option that the beneficiaries have to pay the estate tax is to sell the asset, which typically is not what the original owner wanted or intended. So
Right, right.
that'd be helpful.
Yeah. And the other thing to touch on too, and this is really going to affect people that live in a high tax state. So us here in California are going to really like that. But so currently, right now, the current tax bill has what's called the SALT cap. So SALT stands for state and local tax deduction. So this is all when you're itemizing, and it includes things like your property taxes that you pay, state taxes that you pay in your wages, just through withholding, DMV fees, things, anything that you're paying to whatever state you live in. At the currently right now, all of that is capped at just $10,000. So, you know, let's say your property taxes are $8,000, and then what you pay into just with state withholding is, well, heck, let's just say it's $8,000 too. So let's say your total state taxes that you pay throughout the year is 16,000. Well, that right now that's only capped at 10,000. So you're missing out on that extra 6,000 that you paid. And a lot of times, and especially here in California, I see um, people are paying a lot more just because their property taxes alone, especially if they're buying new, it's going to be north of 12 to 15,000, and then on top of that, whatever they pay in just a state withholding. Um, we're talking about or increasing that limit, so there's still going to be a cap, but instead of 10,000, they raised it up to 40,000. So if that does pass, many taxpayers within these high tax states are going to see huge tax savings because they're going to be able to take advantage of much more than what we've currently been for the past 8 years or so.
Yeah.
So that's a huge advantage if that does pass.
No, that's a good one for a lot of clients that we have, like you said, in these higher tax states. Here's one negative that I did see in all the literature. So the mortgage interest deduction would be extended at a cap mortgage of 750,000. Right
Yeah.
now, if the sunset happens and we go back to the old tax law, it would go back to $1 million that you would be able to write off the mortgage interest on $1 million mortgage, where right now it's capped at 750. So it doesn't look like they're going to be increasing that at all, at least under the current law.
Yeah, and that really does affect people that live in higher tax states, unfortunately. Like we'll take California because we're here in California. The average home price is about 900,000, and
Yeah.
so unless you have a pretty big down payment to get that mortgage balance as low as you can, you're not going to be able to take advantage of all of the mortgage interest that you're paying. It's going to be prorated based off of a certain calculation.
Hopefully the Senate can do something with that. That'd be nice.
Yeah, at least get it up to 1 million, but
I know
we'll
people
see,
are like,
right?
who wants $1 million mortgage? Well, nobody, but at least you want to be able to take the deduction for it.
Yeah, yeah, exactly. But
Well, again, Jay, I think you hit on the really the key areas that we talk about a lot. All of this is up in the air. We will see, like you said, it goes back and forth, but there's a lot happening with tax law changes, and we wanted to at least bring at a high level some of the topics that we thought you would find the most value in. So we hope that you did enjoy it. If you did like the video, please like, subscribe, and we look forward to seeing you in the next video.